I bought $130,000 into VOO and I sold all of my other investments. Right here, I sold 60% of all of my investments, a whopping $132,000, and I put it all into that one investment. So as everybody knows, guys, I am the most boring investor on YouTube. Everyone knows it about me. But today, I made this huge change in my investments where I basically sold off 60% of all of my investments and I put all that money into just one investment. Talk about maybe today is the day I'm not known as the most boring guy here on YouTube. But overall, this decision had nothing to do with emotions, had nothing to do with the market being down. It had everything to do with I've been thinking about doing this for a very long time, and in this video, I'm gonna break down exactly what I put my money into and exactly what I sold and why I actually did it. Now, I always believe this, guys, okay? When it comes to the stock market, when it comes to investing, when it comes to money, one thing is knowing what you have to do, and another thing is actually putting that thought into action. Because sometimes when everything is scary, it can be very hard to make the right decision, even that you know that is actually the right decision, okay? So in this video, I'm gonna break everything down, and as always, like this video. On top of also subscribe and hit the bell so you get notified. And no, don't think it's not about the long-term team anymore. It's still long-term, and this still is a decision that makes a lot of sense, and you will understand it by the end of this video. Now, the very first thing is, guys, you have to understand where my investment journey basically started. About 4 to 5 years ago, I started investing passively, okay? And passively basically means, hey, I'm gonna put some money into this portfolio, I'm gonna let it grow over time, and when I retire 40, 50 years from now, I'm gonna go ahead and basically take all this money for myself. And that sounds pretty good. But whenever you're talking about years and years and years apart, well, making one mistake can basically add up to tens of thousands of dollars. So that's why it's so important that if along the way you figure out that you're actually making an error, you correct it right ahead. Now, my investment journey started out, for example, with Acorns. And as you guys know, Acorns is a very simple app. You get it on your phone. They give you a portfolio of 5 of them, I think it is, depending on your risk level or whatever. You put money in there, they do everything for you. And their portfolios are based on modern portfolio theory. And the idea is, don't worry, I'll use normal English here. The idea is simple, to diversify so that way you don't take on that much risk. But there's this massive difference between risk and volatility. Volatility is whenever a stock is going up, down, and riskiness is whenever what you put your money into gives you or increases your chance of losing money. There's a very different thing here, but no one actually breaks it down and very few people actually understand it. Now, when I first started investing, I was basically investing in a portfolio with 7 different ETFs. Exchange traded funds. And the idea was simple. I had 7 of them. 80% was into stock ETFs and 20% was into bonds. And at the time, that's exactly what I needed because I was still building up confidence in my investments and my knowledge. And I wanted to make sure that if the market took a hit, I wasn't going to feel it or be tempted to actually sell my investments. But then as I grew more in knowledge and understanding, I realized that, hey, Tommy, you're fairly young. Having bonds in your portfolio when stocks outperform them all the time makes absolutely no sense, especially since you're going to be investing for the long term, and that's going to cost you a lot of money. And I said, if I even lose 1% or 2% of this portfolio over 50 years, I'm going to regret it forever because it's so much money compounded over a long period of time. So I changed that portfolio and I sold off those 2 ETF investments in corporate bonds and also in treasury bonds. So then I was left with just 5. And these 5 investments were simple. I was invested into the US market, the small cap market, the international market, the growing foreign market, and also, for example, into real estate. And the understanding, again, was simple. If the US market took a hit, well, maybe the outer market would be just fine. During certain years, we're going to have the US market do great. Other years, it's going to be underperforming. And for example, if the whole market is down, well, I might have some real estate investments in there. So that way, I don't feel that hit. Again, I was worrying about volatility and not about risk. In reality, I wasn't risking anything because if America went down, most likely it was going to take the whole world with them, okay? And it's kind of like this example I hear all the time, but there's actually an extra layer to it. It's like the market is a roller coaster, right? You go up, you go down, you go up, you go down. You only lose if you get off the roller coaster mid-ride because you don't make it anywhere, okay? However, a lot of people, they get on these roller coasters that have very few ups and downs. Very few. And that gives them very few opportunities to actually make a lot of money. And the whole thing is, as long as you don't take off your seatbelt, it doesn't matter how much it actually goes up and down because that's just volatility. It has nothing to do with risk. The underlying business, the underlying country as a whole, as far as, for example, America. And once I understood that, I said, well, why do I have all these investments when I can just basically be invested into this one thing and forget about the rest and basically make as much money as I possibly can as far as a passive investment portfolio? And that's where I went ahead and I sold 60% of all of my investments. And I put every single dollar for passive investing into the S&P 500. And the answer to why that is fairly simple. I believe that in the next 10, 20, 30, 40, 50 years, America is going to be better than it is today. I also believe that if America is not better than it is today and we're not number one or we got shut down or we're not here anymore, it probably won't matter anymore because America is so interlude with the entire world that if we go, they go. Okay? You see what I'm saying here? So once I understood that, I just understood that it makes absolutely no sense. Now, it happened to be that I understood this and I had this idea during a down market. And during a down market, it's even harder to make good choices because you're kind of like, I'm losing money. If I do this and I'm not sure about it, then what exactly is going to happen is I'm going to lose money. Now, to show you guys this, okay, guys, my portfolio and the app I use right now is M1 Finance. And as you guys can see right here, my entire portfolio is actually down around $42,000. That is 16%. But whenever I go ahead and I click inside of it, as you can see, I'm invested fully just into one investment, and that is VOO, the S&P 500. Now, there is one final step I have to do because I also have retirement accounts with those old-fashioned portfolios. I'm going to go ahead and basically just put all that money also into the S&P 500 index over there too. Now, if you go over here, I want to show you guys something because overall, whenever it shows you that I'm basically losing money, it's relative to what the price used to be. So if I started off the year and the market was, for example, like 100,000 and now it's 50,000, well, oh my gosh, we're down 50%. But I never sold anything. So I'm not really losing money. So overall, when you actually go over here, you'll see in VOO, I'm still up a whopping, go right there, a whopping $22,000. I'm still making money. I haven't lost any money whatsoever in the stock markets, and that's pretty cool stuff. But it's not special because I'm not picking stocks. It's just, for example, the overall market. As long as America is doing well, I'll do well, and that's the entire thing. And that's why I made this decision right here. Now, you might be wondering, Tommy, why didn't you just wait until the market recovered? Because overall, you did sell your other investments, which did end up costing you somewhere around $28,000 in losses. And just so you guys can actually see here, right here shows you, okay? I bought $130,000 into VOO, and I sold all of my other investments. Right here, I sold 60% of all of my investments, a whopping $132,000, and I put it all into that one investment. Now, you might be wondering, Tommy, why not go ahead and wait until the market recovered to actually make the decision? And the answer is simple. There are three reasons. First, taxes, okay? If I go ahead and sell during a down market and take, for example, a capital loss, what the IRS allows me to do is basically carry forward those losses at least $3,000 a year. I can basically deduct. Now, if you do the math here, which is kind of crazy, but I was going to do this anyways. So if you're looking at, hey, I'm down $28,000 divided by $3,000, I can basically carry these losses for like 9 to 10 years almost. And to me, that's pretty good because overall, my portfolio with the S&P 500, although I won't be selling or really do anything whatsoever, I will be getting paid dividends, qualified dividends, which is still, by the way, going to be, well, that's going to be taxes, capital gains. But overall, I can still go ahead and deduct that $3,000, which basically makes it effectively so I don't have to pay that many taxes when it comes to the dividend part of my portfolio, which allows me to even grow further and further and further as if it was actually tax-free. So it made a lot of sense from a tax point of view. On top of that, aside from taxes, it was also cheaper. Okay, if the stock market is down right now to the current level that it was before in 2020, which by the way, it kind of is, the answer is, why would I wait until the stock market is up back again to then go ahead and do this move to buy back into the S&P 500 at a higher price? It makes absolutely no sense. So by going ahead and basically selling off these investments now, taking these losses and basically saving money on taxes, taking that money and buying the S&P 500 right now, well, when it does recover, Tommy, how can you be so sure the market's going to recover? Because it's recovered every single time. And if it doesn't recover, we have big problems. And at that point, it doesn't matter. You got to know the game you're playing. It's like, Tommy, how can you be so sure that there's going to be winter? Because it happens every year. You see what I'm saying? So it's kind of the way it works. Now, on top of that long-term perspective, now because this investment portfolio is for the long term, I'm not expecting to take money out in 5 years or 10 years or 15 years. In reality, the way my mind works is in 30, 50-year increments. So that's the way I'm looking at this portfolio. But as you can see, guys, here, there's been this huge evolution from 7 investments to 5 investments to now just 1 investment. And again, I only invest 20% of my monthly income into this portfolio. What about the rest of the money, Tommy, that you're going to be investing for investing? Okay, the answer is I'm picking stocks with that money. So that's individual investments, and that's more active, and that's going to be a lot more than this, but it's a part of the game. More of that coming soon. So if you're not subscribed, subscribe to the channel because you'll make a lot of money on this channel. I guarantee it. Now, if you're nerdy like I am, and you're probably wondering, Tommy, how much money do you think this portfolio is going to gain you in the next like 30, 50 years? The answer is fairly simple. Over the past 50 years or so, or like 70, actually no, ever since inception, the S&P 500 has returned about 11.88%, okay? That's not super crazy, but it is attractive and it's actually pretty cool. It's a good compound rate. However, this basically means that if I don't invest money ever again for the next 50 years, don't add a single dollar to this portfolio, in 50 years, I would have the equivalent of $60.2 million. If I kept investments like the way I do it, recurring every single month to dollar cost average and so on, I'm looking to have somewhere around 121 million. Now, that might sound like a big number to you guys, but in reality, that's about 120 million more than I basically need. I don't need that much money at all because I'm perfectly fine living off of $40,000 a year and not really doing anything with it whatsoever because I still don't spend that much money. So the answer to me, as far as investing, this strategy is the best. It makes me the most money. So I'm not going to be selling. I don't have to worry about volatility, aka risk is the one I call it that. And it's kind of like the risk is very low because you only lose money with a strategy if America goes down. If America goes down, we have a lot of things to basically worry about, okay? It's not just going to be about this investment. Now, you might be asking me, Tommy, is this the right strategy for me? If you did it, would you tell me to do it? The answer is no. I don't recommend this at all. And let me explain why, guys. When I started investing about 4 or 5 years ago for passive reasons, not active like I did before that, the answer was, I started this portfolio this way today. I'm telling you guys this today. I sold these investments today. They're sold today. This entire idea is a today idea. It just happened. But it took me 4 years to make this decision because initially when I first started investing, I knew that if I saw a massive dip from having like $1,000 to $500, I was gonna be like, yo, I gotta sell this because I'm losing money. So I made sure I had bonds in there because at the time, I had very weak mindset when it came to investing. And then once I got more sturdy with my mindset, I said, well, let me just do, for example, no bonds, just put it into the market overall, right? And then when I saw that, and I saw when the market went down in 2020, my first reaction was, I want to buy more, and I bought more, okay? So that showed me, Tommy, when the market crashes, you don't really get scared. you become very opportunistic and you kind of become greedy and you want to take advantage. And that made a lot of sense. So that gave me even more confidence. So today, after reading a lot of books and financial stuff and just studying investments, I realized that I'm perfectly capable of having this portfolio because I really don't care and I don't even check it and everything's automatic. So for me, it makes sense. But if you know for a fact that if you invest this way and you see a market downfall, it's gonna force you to invest your money, you won't be able to sleep at night, it's probably not a good idea. The best strategy is the strategy that's going to keep you in the market for longer, not the strategy that's going to make you the most money. It's not. I just happen to be right now saying, hey, after 4 years, I have the confidence to say I'm going to invest this way because it just makes sense. But if I'm going to invest this way to make the most money, but if the market crashes, I'm going to be out screaming and kind of like going crazy, the answer is that's not a good idea. It's better to have a more balanced portfolio if you know yourself that you're not going to be able to handle anything or any movements whatsoever as far as volatility. That's the answer, guys, okay? As always, guys, thanks for watching this video. Comment down below if you have questions. And if you made it all the way to the end of the video, I want you guys to comment down below not that. I want you guys to comment down below boring, okay? Because the boring investor just made a massive move here. But it's fairly simple, and it's still pretty boring, okay? As always, guys, peace out. Long-term team out. Up here is another video. Over here is my face. Click subscribe. And on top of that, follow me on Instagram at TommyBryson. And as always, peace.